Hello, my name is Alma Robinson, and I am the Executive Director of California Lawyers for the Arts. CLA is a statewide nonprofit organization that was founded in 1974 to serve artists and arts organizations of all disciplines with advocacy as well as services that provide support with legal and business issues. With staffed offices in San Francisco, Berkeley, Sacramento, Los Angeles, and San Diego, we provide several core services. First, we provide legal counseling to specialized attorneys who provide assistance with a variety of intellectual property questions, as well as contract reviews and negotiations and other important business issues. Depending on the client's financial status, legal assistance may be available on a pro bono or reduced fee basis. We also provide a specialized program that assists independent inventors and small startups with their patent applications. To help with situations involving disputes, we provide a range of alternative services, including negotiations counseling, mediation, and arbitration that can avoid the expense and hassle of going to court. Finally, we offer a full menu of educational programs that include workshops, symposia, and conferences on various legal topics for artists and arts organizations. Many of these programs are posted on our YouTube channel, and we encourage you to use these tools to educate yourself on the legal issues before you reach out for specialized assistance from our organization. Thank you for joining today's program. And please consider joining CLA on our website at www.calawyersforthearts.org so that we can continue to maintain our full range of services. Thank you.
Good evening, and thank you for joining California Lawyers for the Arts for Understanding PPP Loan Forgiveness. As you know, PPP is the Payment Protection Program. My name is Renee, and I'm the Educational Programs Coordinator for CLA in Los Angeles. So I'm gonna kind of hide now and turn it over to Keith. Thank you for running this workshop, Keith. It's so great to have you tonight.
So just a little bit about our firm and how we got here. We're Sher Gelb. We're in Sherman Oaks. We're a full service CPA business management firm. We serve mostly clients in the arts and entertainment industry, writers, athletes, actors, directors, and production companies, just to name a few. We also have clients in the real estate, manufacturing, and retail. We do outsource accounting and tax work. Steve here joined the firm in 2011. He's a CPA. And when this thing first started coming down in mid-May, we knew we had a lot of questions and we had a lot of clients that were going to be impacted by this, especially in the production community, which is really where our forte is. So we got on how to apply for the PPP loans and the EIDL loans. And then as the 8-week period started into 1 to 2 to 3 weeks, we started looking at, what we were going to have to do to help get forgiveness. These programs were rolled out pretty fast. Both of the PPP and the EIDL programs were extensions of prior programs the SBA had, and they kind of revamped them and pushed them out real quick. And since then, there have been a lot of rewrites and changes, and those still continue. And that continues into the forgiveness process. Steve will go over some of the trends and some of the expectations we have. A lot of these things are going to be changing. So some of the answers you get right now, we don't know because we don't have the guidance. And some of the answers may change. So it's one of those things you'll have to, if it's important to you, even if we say this is the way it goes, you need to check a little bit later.
Good evening, everyone. As Keith mentioned, the PPP loan has been evolving almost since the first day it started. I remember we'd have conversations with clients and it was like a broken record expressing to everyone, this is what I know as of now, but it's likely to change and it would always change. So same thing stands. This is what we have for now, but there are some things in Congress that could completely alter everything that's currently being spoken of. So firstly, a few disclaimers. This presentation's solely for the purposes of enhancing knowledge on the PPP. There's no professional advice to the borrower. Contact your legal and tax people if you have any questions. We're providing material for this purpose. Now we'll start into just a bit of an overview because I thought it would be a good way to start. Originally, when the PPP came out, all of the costs were based on 2.5 months, but they only gave you 8 weeks to spend it. Then later on, they altered it to give you 24 weeks. So borrowers have the choice of 8 to 24 weeks. And there is a caveat, which we will talk about in the next slide. Payments are deferred until forgiveness is complete. So no payments are due until the SBA rules on forgiveness. That's when the payments begin. As with interest, interest starts to accrue from the beginning of the date of the loan, but it will be forgiven if your full amount's forgiven. Only interest is due on the amount that is not forgiven. So the covered period begins the day that the money hit your bank account. So whatever date shows up on your bank statement, that's the first day of the covered period. And anyone that got their loan before or were allocated their loan before June 5th, they have the option of picking 8 weeks or 24 weeks. Anyone that received their loan after June 5th will have a 24-week period. They can't go any shorter. But the 24-week period, we figured, should get everyone to spend most of the PPP money. And another thing, there is an alternative covered period, which we will talk about. That's only for payroll. And we'll go over that when we hit the payroll section. But that is a blessing, I think, for most clients because it makes it a lot easier to keep track of payroll costs and wages and all of that. Now we go to this section. Borrowers are eligible for full forgiveness. There is the possibility of not attaining the full forgiveness. And originally when it came out, when there was a 75-25 rule, there was no such thing as a cliff. When the new rules came out, we thought that there could be the possibility of a cliff, which meant if you don't spend 60% of your PPP loan on payroll, we thought that you might have the full amount be unforgivable and all of it becomes a loan based on the way it was written. That changed. And essentially what that means is whatever amounts forgiven, at least 60% will have to be payroll. So if I got a loan for $150,000 and all I used on it for payroll expenses was $60,000, the max I can get forgiven is $100,000. So 60% is payroll, 40% is for the other allowable expenses. And then the other $50,000 would just be a loan that I'd have to pay back. And I believe the interest rate's still 1%. The way currently the applications are working are the applications get submitted to the bank. Then the bank will review your application. They might ask you for more documentation. Once they feel they have a good full package and they agree with what the borrower decided was their forgiveness, they'll take that amount or take that loan and send it to the SBA. The SBA is the final determination of loan forgiveness. It's not your bank. It'll be the SBA. They'll decide on if a loan's forgiven. And I think the SBA just opened their portal, but most banks are not opening portals because a lot of them are pushing back and they're trying to get automatic forgiveness. And that's something I was just reading today, JP Morgan, so Chase, I think Wells Fargo, a lot of them are holding off until some of the bills that are on Congress get passed or likely get passed or don't get passed till they decide to move forward. But borrowers have 10 months from from the last day of their cover period to submit an application. I don't see why you'd want to wait that long if there is an application to submit because it just delays the process. I would advise most of our clients to get it done as soon as we have everything. So you do have 10 months, and then I believe the bank has 90 days after they receive your application, then the SBA has another 90 days. So it's a long forgiveness process. It's not going to be super fast, I don't think. Kind of the way the process was at the beginning, and it was ever evolving, as we found out. So we discussed there's a 60-40 rule. So the loan could be used 100% for payroll, but it can't, and still be forgiven, but it can't be used 100% for, say, rents or the other few accepted expenses. 60% must be used for payroll, and then 40% can go to mortgage interest on business mortgages. It can go to rent and utilities. And we'll dive deeper into what qualifies as utilities and rents. But yeah, it has to be 60-40. And they have to be used on those items. There is discussions there's been, I would call them threats on the interim final rules. They've stated that if the loans are used for anything outside of the scope of these 4 things or 5 things that are allowable, there could be legal or criminal punishments. And I think there have been some notable cases in news where some people have taken a $2 million PPP loan, bought Lamborghinis, and they've been indicted for fraud and other things. So the PPP loan is much more restrictive on what you can use money for. And it's only these things. You can't use it to buy equipment, pay personal taxes, pay extra bonuses to yourself. It won't work for that. It'll just work for these expenses. Now we'll go a little deeper into payroll costs for borrowers which have payroll costs. And I think I saw a question about sole proprietors or people without payroll costs. We are going to touch on that as well. But first I decided let's start with the payroll costs or people with payroll. So there's two types of employees. One is the owner and then the other one's everyone else. There's restrictions. The only reason I say that is because there's restrictions on owners and then there's less restrictions on other employees. And as we stated earlier, there's the alternative payroll covered period. The way the alternative payroll covered period works is you can choose it, and the only way you're allowed to choose it is if you pay your payroll every 2 weeks or more frequently. So if you're bi-monthly, you can't qualify for the alternative payroll covered. But it's advantageous because what happens is if I got my loan on the 20th, but I'm halfway through my payroll, I don't want to allocate 1 week to this portion and then 1 week way at the end. What I can do is I'll say, okay, my payroll covered period, so the alternative covered period will start the day after this payroll ends, and then I'll have 8 weeks or 24 weeks of payroll. And it'll just match completely with the payroll. So there's no divvying of expenses or allocating from this period to the next period. So I thought this was super beneficial for a bunch of clients. Cash compensation is capped at $100,000 annualized. And this jives with how we originally calculated the loan. They gave you 2.5 months and it was 100,000 divided by 12, you multiply by 2.5, and the max was 20,833 for everybody. When they altered it now to 24 weeks, the max for an employee that's not an owner is capped at 46,154, and then for an employee for 8 weeks is 15,385. This should theoretically get most people fully forgivable based on these numbers. And then some of the other payroll costs. So there's cash compensation, and then we have employer contributions to employee health insurance. That's just the amount that the employer pays for the employee. So if I had a health insurance plan and it costs $500 for me to have Keith on my health insurance and he's my employee, and I said, okay, Keith, I'll pay half of it, $250, you cover your other half and I'll take it out of your paycheck. I only can deduct, or I can only get forgiven of $250. The other $250 is Keith's money. I can't have that forgiven since I'm not paying it as the employer. Then employer contributions to retirement plans such as 401k matching or any profit sharing plans, those are also deductible as only for the amounts that the employer pays. So if Keith had a 401k deduction on himself that he put in, let's say 10% of his wages, that's not forgiven in my calculation. The only thing I can is if I match, let's say 2% of Keith's salary, that's the portion that I can get forgiven. And then there's also the employer portion of the state and local taxes paid. So those 4 items all go into payroll expenses. All of those will account towards the 60% of payroll costs. So I think most of the payroll agencies are working with their clients. I know Paychex is, ADP, Gusto, and Gusto has a really good platform where they've created the PPP loan forgiveness calculation for clients. They do the full-time equivalent calculations. They do a lot of it. So if you do have some of these payrolls, and I'm not sure about QuickBooks because we don't use them as much for payroll, but if you do have any of these payrolls, I would say ask them if they have any kind of tool that helps, because that would be super beneficial. It'll also cut your accounting costs or any costs for hiring or asking for help with this, because if you have all that information, it makes it really streamlined to get a lot of that information in. Now I think we can segue to owners and payroll costs for owner employees. And these are mainly S Corp or C Corp owners because they get paid salaries. LLCs get paid guaranteed payments, and that's separate from this. These are mainly for owners that get compensation, cash compensation. So owner employee compensation is capped at 2019 compensation limits. So if I had a few employees and I got $100,000 loan, but my salary last year was $50,000, if I chose the 8-week period, all I can get is $7,692, since that's 850 seconds of $50,000. I can't pay myself, the max under the 8-week period, which is 15,385, or the max under the 24-week period, which is 20,833. I can only pay myself whatever period I choose, 8 or 24 weeks, based on my 2019 compensation. So that's where a lot of our clients got caught if they had, you couldn't give yourself a bonus. And that was one interesting fact. But again, the way the calculations work, even if you're a sole owner of an S Corp, the 24-week period should get most loans forgiven. From what all the math that I've done, all the different Excel spreadsheets that I've done with most of our clients, that the 24 weeks should be almost a no-brainer for most clients. It just should get most of the amounts forgiven, except for there are some exclusions, which we'll talk about a little later. Then employer contributions for owner employees are also capped at 2019 amounts. So same example, if $50,000 SEP contribution into my SEP plan as an owner, I can only deduct 8 weeks of it, or 2.5 months, since that's where we're capped at. If we choose a 24-week period, we get 2.5, because that's what the loan was based on. So we can't give ourselves more. We'll be able to take what the loan was based on. So we get 2.5 months of 12 months of the max contribution for the pension. Health insurance is not forgivable, or it's not included in the forgiveness calculation, because for owners, it's part of compensation. So that part, and that was one of the guidance that came out, I think, last week when they released the August frequently asked questions, which was semi-puzzling because originally that's not the way it was intended, but that's the way the new law came out, or the new frequently asked questions described them. Then I think we can pause for a second now if there's any questions, Keith.
Can I qualify payroll 100%?
I think under the old 8-week program, that wasn't possible, but I believe it is possible under the 24-week, isn't it, Steve?
It's possible. It would have been possible then too, but only if they added employees from when they calculated the loan. But yeah, under the 24-week, I think most people will use it for payroll, since you're going to have 24 weeks to have taken, I think 2.5 months is, I think 14 weeks or something like that. So you have a lot longer period of time that's covered, or 10 weeks rather. So payroll most likely for a lot of clients will be 100%, and that should be forgivable. The key number is payroll. Payroll is the holder of full forgiveness. If you use 100% on payroll, you get 100% forgiveness, as long as it's used appropriately. But if that's the key figure, it's just you have to hit the 60% payroll minimum, or else you're not going to achieve full forgiveness.
Yeah, I'm not sure it's mathematically possible under the 8-week, but under the 24-week, I think it is.
If the employer retirement plan is paid annually outside the loan period, can it be used for forgiveness?
I don't believe so. And what we've done is we've worked with some clients to pre-fund their pension plans during that period, so it'll qualify.
That's correct. And there was a blurb in the new frequently asked questions, and I want to quote it appropriately, but what they said was you can't accelerate pension expenses or retirement expenses into the covered period just to have them into the covered period. And they didn't go further than that. It was quite broad, but to me, I understood it as, if I had a salary so far of 100,000, all I get is 20,000, let's say, I can't pay in, even if my pension plan last year was 100,000 or something, let's just say a number, I can't pay in, I can't accelerate amounts from prior to the covered period. But I would say, like we did with a lot of our clients, is especially for some of them that were sole owners, if they had a SEP plan or some kind of profit sharing plan, their loan was based on 2.5 months of payroll and 2.5 months of profit sharing, you should still be able to get those two amounts forgiven, or a part of the payroll cost. And what we told our clients is fund the plan now, because you can't just incur the expense, you have to actually pay it out. It has to be paid in the covered period for the retirement plan. So the best bet is fund it now for the appropriate amount.
Steve, do you know anything about related parties if you own your own building? I think if you're paying rent regularly, I don't think it matters if you're paying yourself or not. It just can't be used for a home, but rent was pretty broad.
I believe so. Yeah, I think that's accurate. I think the related party stuff or the attribution rules more functioned around the max PPP loan you can get if you had multiple big businesses. Let's say if they all got like $5 million, I think that's when then they would add the rules together or the loans together to make sure you don't get over the max of 10 million. But yeah, I don't think that I recall there being anything. As long as there's a lease agreement, which we're going to talk about in the next section, prior to I think February 15th, then it should be fine. And I think it has to be consistent. It has to be established prior to February.
As a single owner of an LLC, I got a small PPP loan. Can I get forgiveness even though I don't do formal payroll to myself?
Actually, the single member LLC is disregarded for federal purposes, so she's probably filing a Schedule C. And the rules are pretty liberal there, aren't they, Steve?
Yep. And I think we're going to discuss that a little later. I think it might be in the next slide where we are going to discuss the sole proprietors, self-employed people with no payroll costs. And I'll touch on that. That one is much more liberal, and we'll discuss that one then. But I think you'll get your answer. So, because this will answer the question, payroll costs for borrowers with the Schedule C. And this was, I think, I'm sure a lot of people have Schedule Cs, sole proprietors, self-employed people, anyone that gets paid on a 1099 or has a single member LLC, you file a Schedule C. With Schedule C, this one was probably the easiest, most slam dunk forgiveness calculation because it didn't take into account any exceptions. There were no rules. The way the calculation to obtain the loan worked was you take your 2019 Schedule C net income, and I believe it's line 31 of the Schedule C, and you take that divided by 12, multiply by 2.5, that's your PPP loan. Originally, when it was an 8-week period, you were capped to 8/52 of your loan amount or of your net income from last year. So most clients, especially Schedule Cs, were not going to get most of it forgiven because a lot of them don't have rent expense. They have some utilities, but I think in most of the calculations we were running, they wouldn't even hit the 60 or the 75% mark back then. Then they dropped it to 60%. So then it got much more favorable. The caps are the same as owners of corporations. If your profit in 2019 on your Schedule C line 31 was over 100,000, you were capped at 100,000. So then the 8-week period was 15,385. The 24-week period was 20,833. So the way, once they rejigged the rules and they changed it to 60/40 and they said you have a 24-week period, almost every Schedule C should get it all forgiven if you have no payroll. If it was just if your loan was originally based on net income on your Schedule C, then you take that amount and it'll be the 24-week. It'll be the exact same. With Schedule Cs, you don't have to you don't cut yourself a check. You don't even need to cut a check to yourself. You could, just to make it more clean, and you have documentation showing the bank, this is my cash check register saying this is the money that came out. It matches my PPP loan. It's the max I can take under the 24-week period. But the way the code was written was for sole proprietors and Schedule Cs, the PPP loan was considered compensation replacement. So that amount was just allocated to you and they would just assume it was compensation because it's as if you were paid that money under payroll. You don't have to cut yourself a payroll like most all S Corps or any owners or employees we had to do. So no payrolls needed. And we'll go over the applications later, but you just state what your loan amount is, how much you use for payroll costs, which will be the full amount, and then that'll be automatically forgiven since it's compensation replacement for a Schedule C. There's no retirement benefits. They weren't included originally in the calculation. So for Schedule Cs, those aren't included in the forgiveness. That was separately stated because for Schedule C's, retirement benefits go on the deductions against income before you get to AGI. So that's not included in forgiveness. Health insurance premiums for Schedule C owners also are not included because those as well were not included in the original calculation. Those are also separately stated. So those are a few items that don't get included in the calculation for forgiveness. And then as I said, 24-week covered period should get full loan forgiven because it's 2.5 months divided by 12. It's the exact same calculation. You take your 2019 net income on your Schedule C, divided by 12, and then multiply by 2.5, and that'll be your max you can take as a forgiveness. So it should match the exact same. And then I was going to go over the payroll costs. Now, for non-payroll costs, which they call qualified costs, these are the other expenses or other costs that we could take that could be forgiven as long as we hit the 60% payroll. And these could amount to as much as 40%. It could be 0%. But the costs that do qualify are rent on business property. So that could be rent on a physical space, like our office at Sher Gelb, or if we were renting or leasing a printer, that also qualifies for some, as long as the February 15th or the lease agreement was prior to February 15th. Then we also have utilities and interest on mortgage. Utilities are electricity, gas, water, internet, and telephone. There was also something about transportation, but I didn't include that because for that it didn't, and I believe they didn't completely clear it out or clarify, but what they did express was it was mainly for if they pay for a bus fare for employees, like some bigger companies have an allocation for bus fare or that kind of stuff, or for transportation vehicles, which most of our clients didn't have, so I didn't include that one. Then mortgage interest, that's not mortgage on a personal property. It's mortgage on a business property. So if I owned this office space that Sher Gelb leases, it's the mortgage on that business property that counts and the mortgage interest on that. There hasn't been a place in the rules where they're going to allow home office deductions. That does not count as rental expense. There's been no discussion of them even bringing it up. So I think that's a moot point. And again, the big thing with all of these 40% expenses, all of these agreements or all of these have to have been in place prior to February 15th. So any lease agreement, any utilities, any of that internet, that should have been in place prior to February 15th, and then it will qualify towards the 40%. And that covers most of what we can use as expenses. And now we're going to go into a place in the code where we'll start to look at what can reduce our forgiveness that has nothing to do with what money we're forking out. That has to do with other factors on employees. And most of this is for people with payroll. There's two major ways that will reduce our forgiveness. And one of them is a reduction in full-time equivalent. And the way the rule is currently written is we take the full-time equivalent employees today or during the covered period. So if I at Sher Gelb have 10 employees during the covered period, and then we get to compare that against two different periods. One of the periods is February 15th, 2019 to June 30th, and then January 1st to February 29th of 2020. The February 15th to June 30th of 2019, it's 2019. So if I had 10 people during that period in 2019, if I had 10 people during the January to February period, and then COVID hit and I decided I can't keep 2 people around, so I have to let them go. Well, now I've reduced the full-time headcount by 2 people. So 20%, since I've reduced it by 20% of my loan forgiveness, even if I properly use all of my payroll for wages, even in the 24-week period, like I can use for 8 employees, I can probably get by with using 100% of it on payroll. I still will not have 20% of it forgiven because I reduced my staff by 2 people. There are exceptions to this, which we'll touch on right after this. The other main way to lose forgiveness is a reduction in salary or a reduction in wages. And the main way this can happen is if I have Keith employed and he is currently making $100,000 prior to the pandemic hitting. And that, I think the way that they're basing this off of is January to February, almost the first quarter. It's the first 2 months. They're going to look at hourly wages or the wages during that period and then annualize it. And then we get to use that as our benchmark. But if I was paying Keith $100,000 annualized for that period, and now I decide I'm going to reduce Keith's pay to $70,000, well, I just went below the 25% threshold. So now I will lose not 5% because it's not dollar for dollar, but there is an incremental decrease in our loan forgiveness. Another way is if you cut someone's hours by 25%, that'll be the same effect. And I believe this only applies to employees making over 100 or below 100 grand. Anyone making over 100, this restriction, the 25% cut restriction, doesn't apply because it was mainly to try and keep lower income middle class people versus very highly compensated executives, they didn't try to pad their payroll, since you're only capped at 100,000 anyways for the payroll loan. So those are two main ways that the forgiveness could get reduced. Now, I like this graphic because I thought it paints a nice little picture of the different things. On the left-hand side, we have the things we talked about, the two ways that we can reduce our forgiveness if we let go of people or cut people's salary by too much. But then originally with the interim final rulings, as they kept coming out, they came up with new safe harbors or new exceptions to the FTE, we'll call it full-time equivalent, the FTE headcount rules. And with the newest, I think after the June 5th passing of the new CARES Act, or the upgraded, I forgot, maybe it's HEROES Act now, I can't remember the title of it. Once that passed, they put in some good safe harbors, or some beneficial safe harbors, as they figured COVID has extended far deeper into the year than they expected. So that changed the way we looked at it. So there's the salary and wage reduction safe harbor. And the way that has essentially worked is you can discount, or if you made a good faith offer, and you have to document all these things to a former employee that you let go prior to or once the pandemic hit. And if you make a good faith offer and give them the same pay, same everything, you document all this stuff, and they come back and tell you they don't want to work for you, or they can't work for you because they'd rather be on unemployment, well, then they drop off the full-time headcount. You do have to document all of this and have it properly, because they could ask for it. And then the other one was, if you decided to terminate someone for a cause that had nothing to do with COVID, that'll also pull that person off the full-time equivalent. So if I had Keith and he was one of my 10 employees and I went down to 9 because I decided to fire Keith because he was stealing money from me, well, the 9th person, that won't count. So it's as if I still had 10 employees. So I'm still not going to get docked for forgiveness. And same thing if I decided to ask Keith to come back to work for me, but he said, I make almost as much on unemployment, I'd rather just go find another job after because I don't want to work for you right now. I can also take that out, because a lot of clients were having issues. And I mean, we've heard cries recently with unemployment and things. A lot of our clients were having issues getting people back, and it was going to affect their PPP because they couldn't spend the money. So this was
one thing in there, Steve, to add is that some of our clients have been getting letters from the EDD indicating that people are applying for unemployment. If you made an offer for them to come back to work, or they were offered work and they left anyways, you have to disclose that to the EDD. Otherwise, you could be subject to a fraud penalty there. So there was some talk about people cooperating with employees and feeling bad for them that they were on unemployment or they wouldn't come to work. But you have to answer those EDD questionnaires honestly, or possibly face some repercussions from the California Employment Development Department.
Thanks, Keith. That's right. And now to go back to that, we have 2 other safe harbors. And I think the first one, I'll talk about it second. The second one was introduced with the new rules, which I thought was super beneficial. The first one we already had, but it was applicable, I think, through June 30th, but then they extended to December 31st. So one of the safe harbors is if the borrower originally lets go of people during the pandemic or right when the pandemic started, and then went through the covered period and was able to use all their costs and everything, as long as you restore your headcount by December 31st, then you still can get full forgiveness. So if I had 10 employees and I let go of 2 of them, and then I went through the 24-week period, paid my 8 employees, used up my entire PPP loan amount, that doesn't mean that I'll lose the 20%, as long as I bring back 2 people before December 31st of this year. That's currently the way the rule stands. And you don't have to, from the way the rule was written, and Keith can jump in and correct me if I'm wrong, you don't have to bring back or keep the same employees. If I had 10 people, I can switch 10 people out. As long as it's just about headcount. It doesn't matter if it's the same person. The quirky thing is I don't know how we'll track that. If we file for an application or for forgiveness, let's say in September or October, we're still 2 months away from December 31st, and they haven't quite specified how we'll or how they'll come back and ask for documents. And they can ask for 941s, your payroll reports, but they haven't specifically said if you just have to check the box and say a good faith that you're going to restore them by December 31st, then you still obtain full forgiveness. They haven't clearly stated that part yet, and that's the part that we're still waiting on. The other safe harbor, which I think could apply to a lot of people, or I thought could be beneficial for in many ways, is that the borrower can make a good faith declaration, and as long as they're able to document that they were unable to operate between, I think it's February 15th and the end of the covered period at the same level of business activity. And that's because of any restrictions that government has put on or whatever's happened with the economy. And that declaration will take away the full-time equivalent calculation, the reduction in full-time equivalent. So if my store, or my restaurant rather, because they're getting hit the most, if I couldn't restore it because I had to only have outdoor dining since indoor dining, or I had to only have takeout, and I can document that I was unable to operate at full capacity or operate at the same level of business, then I also will be able to still get full forgiveness. I'll get to choose that safe harbor. And I thought this was super beneficial for many clients, because a lot of industries, especially in entertainment even, or in restaurants, bars, most of those haven't been able to go back to even 60-70% capacity since there's a bunch of restrictions. So this one was a very good safe harbor, and it appears that they're trying to make it, and this is just my opinion, it appears they're trying to make it more favorable or easier for people to get the loan forgiven, and they're giving a lot more options. And it's just, you have to, a lot of these things are in good faith.
I spoke to a couple of bank officers as this was all coming out, and with the PPP loan, the banks don't actually want these loans. They
Right.
want the loans, they want a check from the government, and they want to go out and make other loans after this. I think you're going to find, and there was a couple of questions, that your bank should be offering you some help. Now, some banks are not going to be as helpful as others. A couple of banks that we know that have been super helpful have been City National and First Republic Bank. It's easy to get a hold of somebody there and speak to somebody, and they really don't want to be holding these loans. They made their money processing the loans. They want the funds back and borrow them. They don't want these loans out at these low interest rates. So that's something to remember. Some of the other larger banks where you are only able to apply online and you're not able to talk to an officer or something, it's probably important that you search around on their site, because they should be pretty helpful in trying to help you get the loans forgiven. And I think they're dragging a little bit because they're expecting some more lenient rules as things go on. They learned this when they started to make the loans. Most of the banks hired a bunch of lawyers to help them get the loans through, and they didn't really know how that was going to function. I mean, it literally happened over a weekend when they were supposed to be making loans within 3 days. Some banks were ready to go in a week or two, and they were heroes. But your bank should be a source, and what we found out in the loan process is that each bank was a little different, and we had to check one bank against the other. One bank said they weren't doing loans for self-employed, and then a week or two later, everybody's doing loans for self-employed, and how they were going to cover the LLC owners in a multi-member LLC. So make sure that you check your bank, check with your bankers in terms of when they come out with the loan forgiveness guidance that each one is going to have.
As Keith said, and I think we learned through this whole process, and if I'm sure most people weren't fully involved, but they were watching the news, and things were moving fast. There were promises. They were saying that you can walk into your bank, get your loan, and nothing like that was happening. A lot of the big banks were freezing applications. It was a hard process, but I think now that most people were able to get their loans, as Keith said, the banks don't want the loans, and that's why a lot of banks now are pushing for them to do broad forgiveness on certain loans. That way they can just move on, call it a day, get their check from the government, and it can just be done. That's kind of where things stand currently, and we'll discuss some of the stuff that's in Congress currently. The next thing is the forgiveness application, and there's two forms. There's the 3508EZ, that's the more streamlined, faster, simpler application that applies to certain borrowers, which I'll discuss. And the other one is the long, I think it's like 5-page document application. That's a little more complicated, where if you have any reductions or choose any safe harbors, that's the one that you'll have to fill out. The first one, I'll have links that you can use to go, and you just go to the Treasury's website and it'll show you, or you'll be able to pull these applications and instructions. But the easy application is for borrowers with employees and no FTE or salary wage reduction. So that means even if you're choosing a safe harbor or something, that won't qualify. It's if I had 10 employees prior in both of those periods, and then I have 10 employees during the covered period, and I didn't reduce anyone's wage, then I can use the easy application. Or if it's also for borrowers with no employees. So any Schedule C people, any sole proprietors, they also will qualify to use the easy application. And one thing I forgot to mention that it just came to me was going back on the full-time equivalent calculation. Most payroll companies, I think, are also doing those, since they have all the data on employees, they have hours worked, wages, all of that. And they can give you a full-time headcount based on the way the calculation works. But you get to choose between those two periods, and you can choose whichever period you want to compare the covered period to. So you get to choose between the February 15th to June 30th, 2019 period and January to February 29th of 2020 period. You get to choose whichever. So if I had 8 in one and 10 in the other, and then in my covered period I had 9, I'll choose the 8 since I'll still qualify for full forgiveness. So that was one thing that was beneficial. This application, I think, it's streamlined. Like I said, since you'll just put, these were my payroll costs, these were my other costs, and then you get to your total loan amount. And the calculation is quite simple. They link you to some pages, and then you just have to initial in certain places. But this one was really streamlined and it worked. I haven't done them yet for any of our clients, since a lot of the banks, I think, will also be preparing their own applications that are similar and they're approved by the SBA. So they don't have to follow, you don't have to actually do these, but a lot of payroll companies are preparing these exact schedules for clients, which is great. The next one was the full application. As you see, this is a lot bigger. There's a Schedule A or a worksheet, and this is where you show employees that were making under 100 annualized and if you reduced it. And then there's a bunch of calculations. Again, a lot of payroll companies are taking care of this. This is for any borrowers that have employees that either had reductions and don't qualify for any of the safe harbors, or if you do want to elect a safe harbor, then you still have to file this application. Again, payroll companies are doing these. I've seen, I think Gusto and one of our other clients has a small payroll company, but they had the full application in Excel, exact word for word the way this is. And I was like, this is great. It works, it matches. I made sure it worked well, and I thought this is perfect. So that's another thing, is if you have employees, just bug your payroll people. And if they're not doing it, have them do it, like push them. And if there's enough people, a lot of the big ones are doing it. So that's a good thing. The next thing was, actually, I want to touch on, I don't have a slide for it, but some of the documentation that you'll need. It's going to be similar to the documentation that they asked for during the original loan process. So you'll need payroll reports during the covered period, and they might ask you for ones prior so they can compare your full-time equivalents. They'll ask for calculations on full-time equivalents. They might ask for bank statements to prove that you made payroll payments. You'll need lease agreements potentially. So you'd want to get everything. If I have a utility expense, I'd want to show, these are my invoices from, let's say, SoCal Edison for the 24 weeks. And these match, these fall in the covered period. And then I want to have a bank statement that shows on, June 5th, I paid SoCal Edison, and that ties to SoCal Edison's invoice. It's on my bank statements there. It clears. I would do the same thing with rent. I would do the same thing with mortgage interest if I had it. You just want to document as much as possible, print out as many receipts as you need, credit card statements, bank statements during the covered period. The key is remember your covered period, and the easiest way to do it is go on Google, type in date calculator, you put in the date the funds came in, and then you add either the 56 days for 8 weeks, or you add 168 days for this 24 weeks. And that'll tell you what your covered period is for the full loan. So just keep documents of everything. What I've done with a lot of our clients is I have an Excel sheet. Originally, that was based on the 75-25 rule that had, I would put in information, and as they paid their payroll, they'd give me their payroll journal and I'd document it. And I'd have, okay, this is their payroll journal on this date. It falls in the covered period. And then that is the total payroll cost. Then as they paid their rent, same thing, document it. And I would just go on and go on. That way, then I have an Excel sheet to back up all the numbers. I'd have them keep all of the bank statements and print them out to PDF, send them that way. If the bank asks you for it, you have it accessible and it's easy to find. Keep tabs of everything, as they could ask you for anything. And bank statements and agreements, lease agreements, those are big. They have said that they might ask you for that. So make sure those are documented prior to February 15th. They're there, they tie to your rental amount, and everything is included. And then future of the PPP. Keith, did you want to touch on some of the stuff that's going on in Congress?
Actually, probably the major thing right now that we've been dealing with some of our clients as we look through the end of the year, and some industries are coming back quite nicely, they're recovering well. Since the IRS came out shortly after the PPP or the CARES Act came out, they actually said that the expenses that you pay using the PPP money will not be deductible. So basically what ends up happening is any PPP that's forgiven becomes income because you can't deduct the expenses. And anything that becomes a loan is a loan and you don't have to worry about paying tax on it. But right now there's 4 bills in Congress to try to correct that. And most everybody threw up their arms and complained about it. The organization that we belong to, the AICPA, is lobbying. Most of the banks are lobbying also. 2 of the bills have 30 or more co-sponsors, but none of them have really reached the floor for a vote. Probably something to write your congressman about or senator. So, if you received a $150,000 PPP loan and you used it all for payroll, let's say, in the 24-week period, when you look at your income statement, unless you add the PPP loan as other income, you're not going to really see what your end of year situation may be. And for some of our clients, it can be quite a nasty little message that you're going to have to pay tax on that money. So that's one thing to keep. We're hoping, I'm kind of surprised this didn't move a little bit faster. I think it hit, I think even Mnuchin came out right afterwards and said, no, it's not, you should still be able to deduct the forgiven expenses. But just as you look at your own record keeping and stuff, you might say, well, I have 0 income, I'm break even because I had the PPP. But you have to add the PPP money that's going to be forgiven to your taxable income.
What I was going to add was what we've told a lot of our clients is, since they don't want to document or they don't want to attribute some of those expenses to the balance sheet or anything like that, what we've told a lot of our clients is, once you got the PPP money, put that as other income on the profit and loss statement. That way, if I had a $150,000 PPP loan, it sits in other income. All my expenses for payroll, rent, everything that qualifies goes in their normal G&L in the P&L. And then that way they'll offset and we don't have to worry about, oh, did we back out the PPP expenses? What amounts of PPP? If it's all forgiven, currently the way the code is written, or the way the IRS rather interpreted the code, was that they're not deductible. So we've just told our clients to do that. And kind of like, not history, but what they were saying, originally what happened was, it wasn't in Congress's intent for these monies not to be deductible, but the IRS has a rule that if a loan is forgiven and it's not income to the borrower, then the deductions are not deductible if there were deductions attributed to that. So that's why IRS took their point on that. And Mnuchin and a bunch of Congress are trying to change that to have it deductible and still forgiven. That's one big item that we're still waiting on. We thought would get passed with the new PPP guidance that came out and the additional money. We thought that's when that was going to be included in there, but they did not. So as of now, the way it stands, it's still not deductible if it's forgiven. And California does not conform to the IRS or to the federal government. So for California, the loan will, if it's forgiven, is still income. Keith, that's correct. Stop me if I'm wrong, but I'm pretty sure that's the way California has looked at it. So in California, it's going to be a net 0. for the PPP loan. Bills in Congress. Currently, a bunch of the banks, as I was stating earlier, JP Morgan Chase, Wells Fargo, pretty much all the banks are lobbying Congress to forgive any loans under 150,000 automatically. And just do a good faith, check the box that they use the money appropriately. They can get audited or asked or requested to provide documentation. But a lot of the big banks want unilateral forgiveness for loans under 150,000. And that's something that's gaining steam. They've been talking about that for the last few weeks. And JP Morgan just the other day came out and said, we're not doing the portal yet for the PPP. We're still pushing Congress. Like, they need to forgive any loan under 150. So that might gain steam, and that'd be great, because then I think most clients and most of our clients, or a lot of them, not most, but a lot of them, and then I'm sure a lot of people on here will get automatic forgiveness. They don't have to worry too hard about filling out those applications correctly, waiting a year and a half. So that's one thing. And they're also talking about forgiveness, or more streamlined forgiveness for loans over 150, but between 150 and 2 million, where you'll answer a few questions and sign off in good faith, and then you can get audited or ask for documents at any time. So there's some good things coming out. The other thing was, they're also might be talking about getting more money to people, and that's just in the infancy, but they're thinking of another PPP or doubling the PPP for people. So that would be great. So these are some of the useful documents. Go to the Treasury's website, treasury.gov, and then there's a red banner that pops up. If you click that red banner, it takes you just to PPP stuff. There's a bunch of good links there if you want to read and have some good Friday night reading or Saturday night reading. And the applications are there, the instructions on there. That's Keith, that's me. You can send me an email at steve@shergelb.com if you guys have any questions. And then Keith, should we do the questions now?
And probably one of the last things to emphasize is that hopefully everybody has a tax professional and somebody that, because most of us in this profession have gotten into it, and they'll be very familiar with your specific circumstance. And sometimes I notice that words change their meanings when our clients say them to us. They don't mean the same thing to us, so we have to spend a little bit of time making sure that we're talking the same language. So
I had planned on using a PPP loan 80% for payroll and 20% for allowable expenses. Can I change my usage?
yeah, I believe you can change your usage, and I do believe with the 24-week, you can get 100 or a greater percentage forgiven through payroll now. The rent paid to the building LLC owners, I do believe that will qualify. I would probably be double checking on that, but we do have some clients that are in that situation, and I think without a doubt we'll be looking to use those rent payments in the normal course of business. A while back, I was part of a Zoom meeting with a industry group that included about 400 people. I stayed around for about 10 or 15 of those meetings, and there were like 3 or 4 a week. One of the problems gets is if somebody's trying to game the system, then the questions get a little wild. But in the case of like this with a building, if you've been paying yourself $30,000 a month for a commercial piece of real estate then that you own, and you continue that, you should be fine. This has been great.
Thank you all. Have a good night.
Bye.
Bye.